What is happening, people? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about 5 of what I believe to be some of the best stocks to buy right now. The general consensus of people in the stock market world is that the large majority of companies are overvalued right now, simply put. The world as a whole is still in a crazy place. The market doesn't make much sense, so it can be hard to find some good stocks, some good deals to buy, whether it's growth stocks or dividend stocks, whatever it is. It's very tough to find good valued stocks right now. So today I'm going to cover 5 different stocks that I personally believe are at quite a good value right now and I would be inclined to buy. And all 5 of the companies we speak about today I do indeed own. I will show you my positions, how they've performed and so on. But guys, another green day in the market. It just feels so wrong every time I open the app and see that I'm making money. I don't understand how there isn't some red days. And the fact that there haven't been any red days is honestly quite concerning. But I'll save that for a full video soon. Right before we get into the 5 stocks, can I ask you to please smash that like button? It helps me out so much. It helps out the YouTube algorithm. It encourages me to keep making these videos. Please do subscribe if you're new around here. We've broken through 5,000 subs recently. The road to 10,000 is on. That's so exciting to be saying. And drop me a comment down below. Let me know what you think of my picks and any companies that you think, are of good value or undervalued right now. And of course, I am not a financial advisor, baby. Everything in this video is just my own thoughts and opinions. So with all of that being said, people, let's get straight to the juicy stuff. Let's get to the first pick of the day. The very first company we're having a look at today is AT&T. I will have a full video on these guys coming out very soon, but I want to touch on them in this video. So these guys here, AT&T, alongside Altria, are 2 of my very favorite high yield dividend companies. AT&T, as of right now, has a dividend yield of 6.71%, a dividend safety of 65. I do personally believe the dividend is very safe. Now I'll get into why a little bit later. A market cap of 221 billion, and where are we? An uninterrupted dividend streak of 36 plus years, making them a dividend aristocrat. Now honestly, I just want to get straight into the juicy stuff. If you've watched my videos, you know that I like investing in high yield dividend companies who I also believe have the potential for massive growth. I want the best of both worlds. AT&T is a company who has traded at $55, $56 in the past. So be it, that was all the way back in 2000, a very long time ago. And a lot has changed since then. What we're really going to focus on is the last 5 years, okay? And upon looking at this 5-year graph, things look very bad. We can see that from the peaks, as of right now, AT&T is down about 26.4% on the 5-year chart. And it was a steady decline for the better part of a couple of years. It was very poor. But then what happened, okay? In the last year, 2 years, we've seen some really nice upward growth until this crash started happening. Now, nothing absolutely crazy, but do keep in mind these guys have that big dividend yield. So in about a year they gave back, about 35 to 38% and that dividend, which is absolutely fantastic. And then from the recent highs down to the recent lows, they dropped 31% in value and they're still down about 19.5%. So a company who hasn't performed particularly well by any means. What I'm interested in speaking about in particular are these years, the years of 2016 pretty much through 2018. Why were these years so poor for AT&T? July 24th, 2015, AT&T acquired this company called DirecTV. Their primary competitors at the time are Dish Network and cable television providers. Not too soon after this, the world of streaming became massive. The likes of Netflix became massive, and now there are so many streaming platforms, and sadly, cable TV is dying. So long story short, this company, DirecTV, ended up doing absolutely terribly, okay? AT&T acquired DirecTV in a transaction valued at $67.1 billion. As of the first quarter of 2017, it had 21 million subscribers and revenues of 12 billion. As of the end of Q3 2019, their subscribers had fallen to 16 million. So simply put, it was a very poor investment, and that is heavily reflected in the stock's price after this happened. After it happened, it very briefly had this nice move to the upside. In a very short period of time, they went up 25-ish%, and then things started to take a turn for the worst. On October 22nd, 2016, AT&T recently to buy Time Warner for $108.7 billion. And then in June of 2018, okay, in order to compete with streaming giants like Amazon and Netflix, AT&T and Time Warner won their bid to merge on Tuesday. Well, on Tuesday, that was obviously back in June 2018. So long story short, there's been some questionable acquisitions that will have led to the last few years being quite rough. However, they have been turning around the last year or so until the virus came and hit. Their earnings payout ratio is in a good place, so I definitely believe the dividend for one is very safe. Their EPS has been going up and up. Now, forecast for the next 12 is down slightly, but look, it is for absolutely everybody. So all of this has left AT&T with a considerable debt load, okay? So as of right now, total cash and short-term investments is at about 10 billion. Total current assets 52.7 billion. Okay, total assets 545.3 billion. Absolutely massive. Now, current liabilities is at nearly 70 billion compared to our 52 billion current assets. So obviously not great. With that being said, total liabilities are just shy of 350 billion compared to our 545 billion of total assets. So I understand it's not the best balance sheet in the whole wide world, but I do think they're fine. I think that their dividend is fine, and I think that their growth prospects are fantastic. Even if those previous two acquisitions mergers didn't go down particularly well, it does just show the initiative that AT&T has. And at the end of the day, they're the world's largest telecommunication company. Like, that says something. I think for the dividend alone, they're at a fantastic price, okay? So from the recent highs to the recent lows, they're still down about 18%. Since 2019, they were showing some really nice growth towards the upside, and I 100% that they can continue doing so. So that's AT&T. I will make a complete full video on these guys soon. I really like the look of them. I forgot to show you, this is my position in them as of right now, and I'm happy with where I'm at, and I may very well buy some more shares. Ooh, baby, you already know how I feel about these guys here. They have to make it into the video, and I still think that in the long term, these guys are at a fantastic price. On the screen now, you will see my position in the company, okay? Now, when I initially started looking at these guys, it was somewhere around here. This is where they were on my radar, at about $49, $50 a share, okay? And I thought to myself, you know what, I think that these guys would be a very good investment anywhere below $35. So of course that still stands. I still think they're an absolutely fantastic investment, and they have done me very well. And the first time I bought these guys, they were actually at about $35. So I'm not just saying that for the sake of it, that was what I thought at the start. So even though these guys are the biggest position in my portfolio as of right now, I still may well put more money into them. I just love them so much. In the last 3-ish weeks, we've gone up nearly 45%, and I tell you, I'm very happy about this, because there was a stage I was down, I think 25, close to 30% on my position in Delta. I never panicked. I fully believe in these guys. I kept buying more shares, and I'm happy I've done so. We have a look on the 6-month chart. From highs to lows, these guys went down a total of close to 70% and are still down over 55%. Now, I understand why people might want to shy away from Delta. You know, the world is going to change. Airports, airlines are going to change. The world of travel is going to change. I understand you. I respect your opinion if you're staying away from them. But if you watch the channel, you know how bullish I am personally on big airlines like Delta. Trump's pushing for US flights back into China. Delta is currently looking to avoid thousands of pilot furloughs, which is obviously a very good thing. A lot of the world is opening back up. It's opening back up to tourists and to the people of their own countries. Las Vegas opens tomorrow. The 4-mile stretch of Las Vegas Boulevard that runs from the Welcome to Fabulous Las Vegas sign to Sahara Avenue. Casinos to open June 4th will include New York Hotel and Casino, the Cosmopolitan, so on. Even places like Las Vegas are opening back up. Lots of European companies are very close to opening back up. The likes of Spain and Portugal will allow people to fly into their countries as early as next month. As soon as companies begin to open back up, as soon as economies begin to open back up, airlines are going to see the benefits very quickly. People are dying for their holidays. I am dying for a holiday. As soon as I deem it relatively safe to be able to go somewhere, I am gone. Delta also have the backing of Trump. You know, Trump has come out and said he's going to help these guys out in specific. He named them as an airline. They've gotten massive bailouts from the government. They've reduced their spending by over 50%. Airport traffic is going back up. There are so many positive signs. If I was willing to invest in these guys at $35 when there was no positive signs, of course I'm willing to invest at this price when there is loads of positive signs. Now again, this is by no means me trying to convince you that you should go out and buy these or any other airline. Everybody's entitled to their own opinion, and I completely respect the people who are staying far away. I completely understand it, I really do. But for me personally, I believe that this price point is still fantastic in the long term, and I do believe these will be one of my best investments. Right, on to company number 3. Another company I absolutely love to pieces. We have the Walt Disney Company. My current position is on the screen. How are these guys actually doing for me? Let me check my phone. So another company who has treated me quite well, you know, up nearly 20% in them. That's something that you very much so like to see. So Disney do pay a very small dividend of about 1.45%. So nothing major whatsoever. You don't really buy these guys for the dividend, but at the same time, it is a nice bonus. Now, one thing I will say about Disney is that their current PE ratio is a lot higher than where it has been in the past. But also keep in mind that a lot of PE ratios aren't very accurate right now because of what's going on in the world. For a company like Disney, for example, a lot of their parks were closed down temporarily. They wouldn't have been bringing in as much money, which is going to push the PE ratio higher. So I don't think it's very fair to go off a PE ratio for a company like Disney, but I still did want to point it out to you guys that, you know, it is quite high. It's sitting at 40. Historically, you know, we've probably been somewhere between, I don't even, 10 to 20. But we have to look at the long-term outlook. You know, in the short term, PE ratios are going to be all over the place. And stocks in general are carrying some more risk. But from the long term, have Disney's fundamentals changed? Have what they do changed? No, they still do exactly what they've always done and more. Looking at the 6-month stock chart, okay, from the highs down to the lows, they lost about 40%, so quite a lot, and they're still down about 16.38%, so they're still down a considerable amount. Look at the 5-year chart, they returned close to 40% in just over 4 years. And we look at the max stock chart, and the last 5 years were the only really, you know, shaky, stagnant, whatever you want to call it, ones in recent history, okay? Since 2009, the stock has boomed up, okay, and I mean boomed up over what, 500ish, close to 500% in a matter of 10 years. Very nice returns, and that's not including dividends or anything either. Quick look at the balance sheet, okay, 14.3 billion in cash, okay, current assets 33.2 billion, total assets 206 billion, and notice this is going up, okay, current liabilities 35.47 billion, also going up, and then total liabilities of 102.32 billion. So again, a company that we see in the long term is looking very good, and then the short term is looking fine. Florida OK's July 11 reopening for Disney World, okay, if this happens, that's going to be fantastic. They're going to start making a whole lot more money. Sure, the park's might be at full capacity for a while, but still, it's going to be more money. It's going to put them in a stronger position. Disney Plus had a fantastic launch, okay, HBO Max, I hate to be saying it, okay, they saw 90,000 mobile downloads on yesterday's launch day, okay. Disney Plus saw 4 million mobile downloads on its first day. So Disney Plus has again been something massive for Disney, and it's came at a fantastic time. It's helped keep them up. And Disney Plus is to launch in Japan on June 11th, in a week's time or so, which is again fantastic for us investors. You know, more people to go buy Disney Plus, more people to boost our share price up, all going well. I just think that with the history these guys have, the parks that these guys have, the hotels, the reputation, the name, the brand that these guys have, is something that very, very few companies in the whole world have across any industry whatsoever. There just really isn't anything like Disney. I was in Disneyland, what was it, a year, 2 years ago, and it was magical, man. I was like a kid running around the place. I promise you, I was like a kid. I met Goofy, man, and I was starstruck, okay? I felt like I was meeting a celebrity. I'll put a clip of it in here. It was crazy.
He found a friend.
For me personally, I just really do believe in them. I think the fundamentals are there. I think they've more than enough cash to get through whatever they need to get through. They've had some good launches lately. They were hit hard and they're recovering hard. I love them, and I do think they're at a fair price despite that PE ratio. With that being said, I'm not too sure if I'll add much more to my position. I would have preferred to get a little bit more in around the $100 mark, but look, it is what it is. Facebook, baby. I'm going to keep this short and sweet. I have a full 15-minute video on these guys if you want as much information as you can handle in regards to Facebook. But here is my current position. I own 2 shares and I'm barely up about 10%. It is a very new position to me. But with that being said, these guys right here, have literally turned into my potentially favourite growth stock. The last 5 years up about 181%. The last 8 years up over 1100%. 6 month highs to lows, they fell as much as 35%, and now they're up 3.56%. So a lot of people have this problem with Facebook, that they don't want to buy them at the top. Look at the 5-year chart, okay? The top doesn't really have much of a bottom. Sure, every now and again it might go down in price, but come on, is there much of a difference between this 204 and this 183? So a lot of people have this argument that they don't want to buy Facebook because they don't want to buy at the top, okay? Right. Let me just say why I don't think that's a very good argument to have for Facebook. This was a top 5 years ago. You don't want to buy here, you want to wait till a drop? Okay, the next time a drop happens, let's say we get to here and then there's a drop. $104. You didn't want to buy at 94, but you're happy to buy the drop of 104? I don't get it. If you decided you did not want to invest in them here at $82 because you wanted to wait for a drop, and the first big drop you see is maybe here, you know, 185, very quickly drops 15%, oh, all the way down to 157, and that's when you want to buy? You've just missed out on nearly 100%. Now, so be it. There was one big drop here. There was a big drop. Still, like, come on. One big drop that's not related to the virus in over 8 years, essentially. If you're waiting for the drop on these guys, you're more than likely not ever going to get in. And by the time the drop happens, you should have probably made money. So that is why I'm happy to buy these guys at the top. Because for the most part, it's always going to be at the top. This balance sheet is absolutely disgustingly beautifully amazing, okay? Cash, 60 billion. Current assets 69 billion. Nearly all of their current assets is just sitting in cash. It's beautiful, okay? Total assets 138 billion. Current liabilities of only 15 billion, okay? Compared to 60 billion they have in cash, pennies, okay? Total liabilities 33 billion. I mean, this balance sheet is one of the nicest that you will find of any company, never mind an absolutely massive company like Facebook. Facebook is currently trading at a PE ratio of 33.28, and for Facebook, okay, this is actually, you know, fairly normal. It's traded around this level quite a lot in the past, and this just goes to show why PE ratio isn't always the best indicator of the value of a company, okay? Especially when we're looking at massive companies like Facebook. We had a PE ratio of 81 back at the very end of 2015. Does that mean that $104 was a bad place to buy? No, because it would have just kept going up and up and up forever, and you would have made, you know, well over 100%, 120%. They're going to have an awful lot of their employees working from home in the next 5 to 10 years. They're changing the way these industries are going to work. That could well save them a considerable amount of money. People don't have to spend as long driving to and from work. They're going to have more free time. They're going to be more willing to work. They own Instagram. They've made over 100 times their money back on Instagram already. They own WhatsApp, which has a 1.5 billion user base that's not monetized yet. They have a lot of streams of making money. I'm going to leave them there. Again, I do have a full video on these guys if you want to check them out. I do recommend that you do that. So the final company we're having a look at today, guys, is Pepsi. A dividend stock that I completely and utterly love the look of. So on the 6-month chart, they fell down as much as just less than 30%, and they're currently still down about 9.33%. And it's been a very slow month and a half or so for these guys. They've just been somewhat trading sideways, but that's okay. It's better than no recovery. It's better than continuing to go down. Pepsi is a company with a 3.08% dividend yield, a 93 dividend safety, and a 47+ year dividend streak. These guys always get directly compared to Coca-Cola, which is fair enough. You know, they definitely are competitors. One of the main reasons I really do like Pepsi and prefer them to Coke, even though I do own both companies, is they have these 22 iconic brands with more than $1 billion in annual sales. And these guys have snacks. They have Doritos, Quaker Oats, Ruffles, Cheetos, Lay's. I've spoke about this before. They have drinks and snacks, whereas Coca-Cola only has their drinks. So a quick look at the balance sheet. These are a company who weren't hit particularly hard by the virus. People were still buying their Pepsi, their snacks, whatever it was, okay? Balance sheet. Total cash. Look how much better this has gotten, okay? 11.24 billion. Current assets, again, has gotten much better from the end of last year. 24.26 billion. Now, we have a look at total assets again, up 85 billion. Then when it comes to current liabilities, 22 billion. Up slightly, not quite as much as the assets have gone up. And then total liabilities, 71.5 billion. So again, up slightly. So the balance sheet is decent. Now, the earnings payout ratio traditionally has been good. Forecast for the next 12 months is 75%, which given the situation we're in, I don't think is particularly poor whatsoever. I think that by the time everything returns to normal, Pepsi are going to be absolutely fine. Now, what I will say is, I don't think this is the most exciting company in the whole wide world. I don't think they're going to give you back hundreds and hundreds and hundreds of percent in the next 5 years. I do think, however, they're just a relatively safe investment, a relatively defensive investment that does have a 3% dividend yield. If we look at the last 5 years, where we were 5 years ago, up until pre-crash, they had paid back about 57.9%, okay, nearly 57%. And that's not including the dividend as well, which would have been a further 15-ish%. So, you know, a decent return, but not the biggest in the world, you know. It's not the likes of a Delta or a Facebook that you expect to pay a whole lot. It's just a relatively safe company. But that is where I'm going to leave Pepsi, guys. I absolutely love the look of them. Oh yeah, here is my position in them right now. A few words for those of you who have watched until the very end of the video. I'm more than likely going to slow down with my investing for a little while just because of the fact I don't see many deals out there. And again, I'm not a financial advisor and I'm not telling you what to do. I'm just letting you know that that's what I'm going to be doing. I still will be investing. It just is who I am. I want to get some more money into the market every week or two, but things will be slowing down. I've already pumped in quite a bit more than I planned on, being completely honest, but that is just because the market took such a big hit. Now I think I just need to wait and see what happens. I need to just, you know, let the waves cool off a little bit. I will obviously keep you guys updated when I do buy stocks, what I'm keeping my eyes on, if I do see any really nice deals in the market. But yeah, I just wanted to let you guys who watched till the end of the video know that's where I'm at. I massively appreciate you watching till the end. If you did, please do smash that like button and drop me a comment. Let me know what you think about what we've spoken about today, or if you have any other companies that you have your eye on that you think are at a very good price. I'm always interested to hear from you guys. And of course, subscribe if you're new around here. The road to 10k is on, baby. So I appreciate you all so much. Hope you have an absolutely fantastic day. I'll catch you for tomorrow's video. Peace.